Hi, I'm Kison with Fundology. Today I'm here with Chris Reed with Shepard Capital, equity and debt investors based out of Tampa, Florida. Chris, could you tell us about some of the deals you're working with?
Certainly, these aren't startup businesses, but these are companies that have gotten out of the gate, have proved out their model, have developed sustainable cash flow from operations, but really need growth capital to kind of take it to the next level. We don't tend to specify any industry in particular that we're going to operate in. Instead, we tend to try and look for market trends or industry segments where there's really a gap between perceived risk and actual risk. And those are the types of companies that we try and find good operators in. We've invested in companies in manufacturing, business services, financial services, in healthcare, entertainment, automotive, retail. So, kind of a wide variety.
Great. It sounds like you're really focused on the lower end of the lower middle market. How does that affect with just in general sourcing the deals and being able to negotiate with the companies?
Sure. As when you're dealing with companies that are on that smaller end of the scale that we're talking about here, these aren't the types of companies that are going to have a lot of attention even from traditional investment banks in helping them to raise their capital. So we tend to source our deals primarily through business brokers, attorneys, accountants, and really kind of the network of people that are out there in the market that are running across these companies. Oftentimes, some of our own investors, will come in contact with these deals and bring them to us. And as you can imagine, like anybody else, we have to look at a lot of deals before we find ones that really kind of meet our criteria.
Okay. And now that you're focused on the smaller transactions, do you see lower multipliers on those deals?
We don't tend to look at traditional multiples of equity or EBITDA or multiples of EBITDA or revenue when we're trying to figure out what our cost of capital is going to look like on these deals. What we tend to focus on is what is the growth prospect within the business, what is the right structure between debt and equity to put in place on the deal, and what is kind of the risk level that we think that we're going to be incurring, and factor those into a model to determine what our target return needs to look like in order to make that work. Our target return overall is typically in the low to mid 20% range.
Okay. As far as when you're working with some of the firms and structuring debt, what do some of those terms look like?
In a debt-based investment, we typically do deals in the 3 to 5 year range. We like opportunities that can provide a current pay component. So obviously, we're looking at businesses where cash flow from operations is going to be able to support monthly or even a quarterly coupon associated with it. And it's typically in the 12 to 15% range. So, not an inexpensive cost of capital, but for the size companies we're dealing with and for that risk profile, we feel like it makes sense. And, we help the company figure out from a modeling perspective how that'll fit into their pro forma projections and how it can help them achieve the growth that they're looking to do.
Can we talk a little bit about value creation strategies?
Sure. Again, with dealing with smaller companies that we're talking about here, and, part of the reason why we focus on that market is that, one, we think it's very much underserved by traditional capital providers out there. So, there is less competition. On the flip side of that, there's also increased risk because these are smaller enterprises. They have, they tend to have a few years operating experience under their belt. But anybody who's been an entrepreneur knows that there are cycles of growth that you go through that can be challenging depending on the people who are running the business. So what we try to do when we're making these investments is we very much look at it as a partnership with the portfolio companies. And we try to upfront make sure that we're aligning the incentives of the business and our incentives so that we can develop a level of trust with the business and use our own operating experience to help them define an achievable growth strategy and hopefully identify and mitigate risks before they ever occur within the business. So, some of the examples of that we've often done is really helping them to set some tight fiscal controls on the business and developing a long-term funding strategy for the company that's going to enable them to get probably the most efficient cost of capital out there as quickly as possible. And for businesses this size, that's often not a core competency that you see out there. So we think that it very much adds a lot of value to the relationship.
Great. Do you have any specific examples of how you worked with firms to create value?
Sure. We have some background on the information technology side of things, as well as on the accounting side. So oftentimes what we'll do is we'll come in there as part of the deal and review where they are from an IT perspective, help them implement systems that are going to help them scale the business as it moves along. And on the financial side of it, again, a lot of these businesses when we come in are running QuickBooks, and QuickBooks is a great tool to have, but it may not scale to where they need to take it. So we'll help them kind of lay out a plan for putting the infrastructure in place that they need to grow the business where they want to take it and help them make that happen. Another thing that we always encourage with these guys, and oftentimes will require it, is having them move to audited financials. It's expensive, it's time consuming, but what we try and drum into these guys, if you want to be a larger operation, if you want to be able to go out at some point and pull in senior capital from a bank, these are things that they're going to look for to show that that your business is on sound footing and taking it forward. So it's kind of lessons like that.
Okay. Now, do some of those strategies also apply in the debt investments that you guys are making?
Sure. No, whether it's debt or equity, as I said before, we try and make sure we align our incentives. So I'll give you an example here. On most of our deals, even on the debt investments, we will take an equity investment as part of it. It may be something where we're buying into the business. It may be something where that's part of our cost of capital, and we'll take it in the form of warrants in the business. But part of the reason that we do that is because at that point we're not a bank. We're not just looking to get our loan paid back and we're going to move on and do the next thing. We're interested in seeing this company grow and thrive, and our equity in that business be of value to the future. So when we try and set these things up, we feel like, as I said before, we can develop some trust with these guys and help them, kind of position themselves going forward. And if they get to a point where on a debt investment that they can reach a more efficient cost of capital through a traditional bank lender or another source, and that means they're going to buy us out early, we don't have any kind of a prepayment clause. As far as we're concerned, that means the business is worth more, and all boats rise with the tide. So we're happy to see that happen, and as a matter of fact, in a number of instances, we've helped them make that happen.
Is there anything you do to keep involved with that company if that point comes in?
That they, to a point where they bought out our investment?
Yeah, for example, they buy out your debt. I mean, is there anything that you do to keep continuing the relationship or involved with that company?
Absolutely. As I said, at that point, we're equity holders in the business, and we want to see it succeed. We've had a number of times where our debt has been repaid and will remain on the board. I'm on the board of several companies right now that we don't have an active debt investment, and part of that is because we personally are involved in that operation, and we've developed a good relationship with the management team, and we're interested in carrying that forward. And as we said, for us to be successful in this business, it's a relationship business, and you always want to have portfolio companies, regardless of how it turns out, that that will look at that relationship and think that it was one of value to them.
Great. Chris, could we talk a little bit about the general sense of your firm and the way it's structured?
Sure. We're a pretty small firm. There is only 3 people that are full-time involved with this. The 2 principals are myself and my brother, David. Probably not something you see every day with family working together on this, but we tend to structure things where we'll do most of the heavy lifting in terms of managing our investment group, as well as managing the portfolio companies, because we do look at their performance every month. We do meet with them every month, try and figure out what that looks like. So we'll divide up those responsibilities within the firm. When we're in a due diligence stage, for making an investment, we have several people that we work with on a contract basis that we'll bring in to do things like quality of earnings reviews. Even though my partner and my brother David is a CPA, it's always good to have an outside set of eyes that are coming in to take a look at the business. We tend to bring in some industry experts in the market that we're looking at here, that that are going to bring some additional outside knowledge to bear in terms of evaluating the deal. We've got legal folks that we work with, so we tend to bring those in on a case-by-case basis.
Okay. Now, who are some of the investors involved in your group?
Well, as I was saying, with this kind of syndication model that we use to invest in these types of deals, you can have a wide range of people that are going to take part in it. David and I put our own capital in every deal we do, so we very much look at it as a model where people are investing alongside with us. We've got a handful of high net worth individuals that have participated with us on pretty much every deal we've done, and will often be part of that closing. But as I said, it's not a traditional fund. It's very much investing alongside of what it is that we're doing. So they trust that we've gone through the exercise to make sure that this meets our criteria for a solid investment. They'll help us kind of get this thing across the goal line, and then what we will do is syndicate it out to qualified, accredited investors that are interested in the same kinds of return portfolio profiles that we're after, but they can do it in much more manageable sizes. Our typical unit size when we're syndicating something out is $50,000 to $100,000, and probably the average investment that these folks will make is somewhere between $100,000 and $500,000. So it's we've probably got a network of 50 to 60 investors that we deal with on a regular basis, and we're always kind of growing that because hey, people like current pay just like we do.
Great. Now, how do you present your deals to those investors, and how much information are you disclosing to them?
What we tend to do with that network that I'm talking about here is we'll put together an information deck, a PowerPoint deck that we can send out to them, and we'll keep it kind of 8 to 10 slides that walks them through what the company is, who the management team are, what their track record has looked like, and then what the investment opportunity is, whether it's a debt-based investment or preferred equity. What are the terms associated with it? What a target return on investment looks like over a 5 to 10 year period, depending on what the deal is, and why we think it's a deal that makes sense and one that we're pursuing. So we'll send that out to this group, and then we've got follow-up steps that we go with them for folks that are interested in it. And then once we kind of narrow down the list of people who are interested, we'll do a more traditional private placement memorandum that we'll put in front of them that's got full financials, all of the legal terms associated with it, all of those pieces that we need to walk them through to get to a completed investment. And we never take any money for an investment until, the deal is ready to close. So it's nothing that we're taking up front.
Okay, great. Chris, one of the things that I noticed is really unique about your firm is that your brother is your partner.
Yes.
Tell me a little bit about that. How does that work, and how long has that been established for?
As I was mentioning earlier, it's not something that everybody, could probably do, but it works very well for us for a number of reasons. One, I can still beat him up. No, it's David and I actually have been in business together in the past. We had a staffing and consulting company in the 1990s that we grew and sold, so we knew that we could operate together well. But I think, he and I make a very good partnership because we do have different skill sets. He's, as I said, as he likes to call himself, a recovering CPA. My background is more on the IT side of things, but we've both run businesses and have that kind of background. And he's been in the private equity space now for about 12 years. I'm only in about year 3 in doing this. So I tend to focus a lot more on, deal identification, really kind of digging into the company, getting to know the management teams. He's very strong on structuring what the deals look like. Both of us do our own share of shoveling when it comes to, working with the investors and putting this in place. It probably also helps that he's located in Tampa and I'm actually located in Jacksonville. So that helps us hit multiple markets, but we're also not face to face with each other every day, which, as anybody can tell you, any kind of business partnership is like a marriage. So, he and I make sure we keep family first, but it enables us to focus on the business. And I can tell you, it's great to work with somebody that you trust implicitly.
Great. It sounds like your guys' skills really complement each other.
We hope so.
Chris, I really appreciate the time and for sharing all the insights with us.
Thank you for having me. I appreciate you bringing me on.
Thank you.
Take care.